this morning, the White House put out a study, and that study claims the 400 wealthiest American families only paid, on average, a federal tax rate of 8.2%. Now, that's much lower tax rate than historically we've heard. And so immediately that headline, the 400 wealthiest American families only paid 8% federal tax, jumps off the page. People say, how's that possible? So let's dig into the report first. First, in the abstract, kind of the summary of it, they say that they estimate the average federal income tax rate paid by America's 400 wealthiest families using a relatively comprehensive measure. Keep that in mind. That'll be important later. Of their income that includes income from unsold stock. We do so using publicly available statistics, yada, yada, whatever. We estimate an average federal income tax rate of 8.2% for the period of 2010 to 2018. They also present sensitivity analysis that yield estimates in the 6 to 12% range. And they then, proposals mitigate two key contributors to the low estimated rate, including preferential tax rates on capital gains and dividend income, and wealthy families' ability to avoid paying income tax on capital gains through a provision known as stepped-up basis. So essentially, what we have here is they went and they did a study. They claimed that they used relatively comprehensive measure of income, and the 400 wealthiest families paid 8.2%. Okay, so far, no red flags, no danger. We are ready to rock and roll. Next piece is when an American earns $1 of wages, that dollar is taxed immediately at ordinary tax income. So we're starting to get into some of the description here. But when they gain $1 because their stocks increase in value, that dollar is taxed at a low preferred rate or never at all. And so what they're getting at here is that the most common estimates of tax rates do not fully capture the value of this tax benefit because they use an incomplete measure of income. Okay, getting a little weird. Next is how the wealthy enjoy low income tax. So now here's an explanation. Preferred rates on an incomplete measure of income. This is a study that was put up by the White House that was done by economists that says the wealthy pay low income tax rates year after year for two primary reasons. According to the White House and these economists, they say first, much of their income is taxed at preferred rates. In particular, income from dividends and from stock sales is taxed at a maximum of 20%, which is much lower than the maximum 37% ordinary rate that applies to other income. Second, the wealthy can choose when their capital gains income appears on their income tax returns and even prevent it from ever appearing. If a wealthy investor never sells stock that has increased in value, those investment gains are wiped out for income tax purposes when those assets are passed on to their heirs under a provision known as stepped-up basis. And then I think we have one last piece of this here, is the study also, again, they keep using this term, comprehensive measure of income. A preferred tax rate on income from stock sales, realized capital gains income, and from dividends feature prominently in commonly cited tax rates as well as in our analysis. An important feature of our analysis that is less common in existing estimates of tax rates is that we include untaxed capital gains income in our more comprehensive income measure as they accrue. All right, that's all what they said. I'm going to walk you through a couple of different things here. First of all, if I ask you what is the tax rate that somebody pays, and you tell me that they made $100 and they paid $10 in taxes, that would estimate, or that would be a 10% tax rate, right? Made $100 in income, I paid $10 in taxes, I paid a 10% tax rate. If I then go and say, I don't actually think you made $100. Instead, I think you made, I don't know, $500. And now that $500, you actually only paid $10 in taxes. So you didn't pay 10% tax. You actually only paid 2% tax. Well, what? If I actually made $100 originally, that's what I reported to the government, and I paid $10 in taxes on it, and I had a 10% tax rate, to use easy numbers, and the government said, yep, that's what you owed us. You owed us 10%. Then I actually paid 10%. To then go and inflate the income based on other measurements that are not currently how income is defined, of course you're going to be able to say people paid a lower rate. This is classic manipulation of data, which is the taxes that are owed based on the current tax system end up being one number. And what this study does is it goes and it says, oh, actually, we're going to drastically expand the definition of income, and we are going to drastically expand the denominator in this equation. And therefore, we're going to artificially manipulate that number down. And then we're going to put a big headline on a report and we're going to publish it on the White House website. It's propaganda. That's what this is. This is propaganda coming from the White House. Now, there's propaganda that works in both ways. Some administrations issue this stuff and they say, hey, people don't need to pay as much tax. We should actually issue tax cuts. Other administrations, like the current one, issue reports that say, hey, we should tax people more. So it's both political parties engage in this stuff. It just so happens that the current administration is trying to advocate for higher taxes, not lower taxes. So the important parts here, one, nobody is claiming, including these folks, that the actual rate that was paid was 8.2% by the 400 wealthiest American families. What they're actually saying is that if we count differently and then we apply what they paid, so if we take a hypothetical amount of income and then we apply what they actually did pay, then it would be 8.2%. But if we actually said, no, we're going to count differently the income and then we applied the tax rates, they would pay way more than 8.2%. So what you essentially have is you're taking a fact, which is what they paid in aggregate dollar amounts, and then you're creating a hypothetical income number, and you're trying to apply a fact to a hypothetical to manipulate data to say what you want. It's intellectually dishonest. Now, on top of that, what this explicitly calls out first is economists, people who are academics. They no longer seek truth. They no longer seek the understanding of markets. They actually no longer even seek accuracy. They merely have become political pawns for both sides of the aisle. There are economists that are manipulating data to tell us that there's very high levels of inflation. And there's economists that are manipulating data to tell us that we shouldn't worry about inflation at all. There's economists that are manipulating data to tell us that we should tax everyone way more, tax the rich, burn it all down, take all their money. And then there's economists that are manipulating data to say we should tax nobody and that the federal government has a spending problem. The truth is probably somewhere in between. But what we can no longer rely on is we cannot rely on economists, because what we have shown over and over and over again is the data collection, the data sets, and the methodology that goes into these types of analysis are completely flawed. They fail any actual pressure or logic. How is it that you can take what people actually paid, which the government has said, yes, you paid me the right amount, and then hypothetically inflate the amount of income that you wish that you could count, and then compare the two things and then say, oh, by the way, they only paid 8.2%. Because if you go look at the tax returns, the actual documents of what those families paid, it's not 8.2%. It's something much higher. Now, we can debate whether they should be paid more or less than what they actually paid. That's fine. That's a fair debate and one that is playing out right now. But what you can't say is that they actually paid 8.2%. It's intellectually dishonest, and I would even go as far as to say it's inaccurate. Now, on top of that, this all comes down to something called unrealized capital gains. The idea of unrealized capital gains is if I take $100 and I buy a stock, and that stock appreciates, and let's say that stock goes from $100 all the way up to $500 in value now. So I put $100 in the system as an investment. That company used that money to go and create jobs, to build products and services, to pay their employees, to pay taxes to the government, etc. They then are able to increase the value of their business. And my share in the company is not worth $100 anymore. It's now worth $500. I'm a great investor. I have not yet sold that stock. And so what unrealized capital gains means is that I went from $100 to $500. I have $400 of unrealized gain. If I was to sell the $500 stock now, I would take back my $100 principal plus $400 of gains. That would be realized capital gains. And I would be taxed when I sell that stock. So what essentially they are trying to get at here is they are trying to count unrealized capital gains as income. Now, there's an entire push in certain parts of the economy by certain economists, by certain politicians, certain social groups, etc., to tax unrealized gains. Now, to give you a sense of how idiotic and stupid this would be, The US stock market, the S&P 500, is up 30+% in the last 12 months. That means that for every dollar that has been invested over the last year, every single person in the stock market owes 30%, give or take, depending on how you count, short-term, long-term capital gains. 20% is long-term, something higher is short-term. I avoid short-term capital gains. And so now all of a sudden, if it's up 30%, that means that every single American who owns a US-based stock would have to sell some of their stocks to pay for the gains that the stock market gave them. You would disincentivize people from investing. It would be a complete new addition of friction. On top of that, you start to look at things like every single American who owns a home. Home prices are up double digits over the last 12 months. Every single American, if you owned a home and it was $200,000, and let's say your home is now worth $300,000. You don't know that for sure, but it kind of sort of looks like that based on comps in your area. If your house appreciated 50% in the last year and you owe taxes from a $200,000 to $300,000 home value, that's $100,000 in unrealized gains. That means you owe $30,000 plus or minus, depending on the exact tax rate you get hit with. Where are Americans going to come up with that? 90% of Americans don't even have enough money to pay for retirement, let alone every year to pay the government because the home that they purchased went up in value. Unrealized capital gains is about the dumbest economic idea that we've ever seen. Because also, we never hear about unrealized capital losses. If I was to buy that stock at $100 and rather than it go to $500, instead it actually went down by 50% and that $100 stock was now only worth $50, nobody's talking about giving me $50 in losses if I don't sell the stock. So how is it that the unrealized capital gains is in the crosshairs, but we don't want to give the same treatment to the people who make an investment, and if they lose money in an unrealized basis, they get the benefit of the loss? It's because this has nothing to do with fairness. It has nothing to do with trying to actually create an economic system that incentivizes investment in innovation, job creation, R&D, etc. No, what it's about is simply punishing success, condemning success, taking from those people who have done something. 80% of US millionaires inherited $0. They built their wealth. They did not inherit it. 80%. 33% of millionaires in America never made more than $100,000. So now those people who have been investing their entire lives, we're going to punish them for being disciplined, for spending less than they make, staying out of debt, buying long-term assets and holding them. You completely disincentivize capitalism. And we have example after example after example in history of socialism absolutely not working. On top of that, are we just going to have National Crash the Stock Market Day? Is that what we're actually advocating for? Is the tens of millions of Americans who are invested in the US stock market, when it comes to paying unrealized capital gains, we're all going to go to the stock market, take a couple of shots of liquor, and then just pull on the wheel and hope to God that when we all sell at the same time to be able to get money to pay the tax man, that we don't crash the stock market? This is insanity. And frankly, it's disappointing to see the White House publish something like this. Now, my favorite part about this also is this idea of stepped up basis. And so let's say that John and I were not brothers in arms and brothers in blood. Instead, John and I were father and son.
Whoa.
And I was an amazing investor. And I bought all these assets through my life. And towards the end of my life, I went ahead and I wrote a will. And in my will, I said, you know what? My kid isn't a deadbeat. He's actually pretty smart. I want when I die, him to make the decisions as to what happened to my assets. This is a pretty normal activity for almost everyone in the world. What happens when I die? Now, when I die, let's say that I had a piece of real estate. That piece of real estate I bought for $100. It is now appreciated over my lifetime, and it's worth $1,000. When John inherits that piece of real estate, rather than the cost basis of the real estate being $100, the cost basis now goes up to $1,000. He inherited it, and so there's a step up in the cost basis. John's cost basis is $1,000. My cost basis was $100. Now, the reason why we do that is because if John ever goes to sell the real estate, and let's say now it's worth $1,500. John will pay taxes on his $500 gain from $1,000 to $1,500. He still has to pay taxes when he sells it at a profit. But that step-up basis is one thing that we are talking about here. Now, if you read this, you would be remiss to think, are wealthy people so worried about taxes that their tax strategy is to die? Is that really the tax strategy that we're claiming wealthy people are taking? Is that I want to save money from paying taxes so badly that I'll die? It's not like wealthy people are off in the corner committing suicide to prevent paying taxes. It's not like they're telling, hey, John, you want this real estate? Kill me, dog. Like, I gotcha. No. Death is inevitable. And so we can argue and debate over how we treat assets. Should John have to pay taxes based on a gain from $100 to $1,500? Or should John have to pay taxes from the $1,000 stepped up basis to $1,500? Those debates are fine. But to insinuate that older people, wealthy people are literally planning death in order to avoid paying taxes is ridiculous. And so when you start to look at the stepped up basis, what you have to ask yourself is, are we trying to punish dead people? Or are we trying to incentivize those that are inheriting the assets to continue to invest in whatever the assets are? The entire point of the tax system is it serves as a carrot and a stick. You can manipulate the tax code to incentivize investment. Now, on top of that, I don't think that we have the political will, nor do I actually believe the people who are saying that they're going to institute unrealized capital gains taxes. Because guess what? The multimillionaires who run the current administration, Joe Biden estimated to be worth $10+ million. Kamala Harris estimated to be worth millions of dollars. And also many of the other elected congressmen and senators, they're not going to sell their stock every year to pay the tax either. This isn't about the little guy, and it's not about the big guy. It's about simply understanding if you want to incentivize investment, incentivize economic prosperity, and incentivize innovation, you can't have a system that punishes people for successfully investing. Throughout this entire report, it says wealthy people, wealthy people, wealthy people. They don't have a special tax code. These rules apply to the richest person and to the poorest person in America. They are the rules. The difference is not the amount of wealth they have. The difference is information. So rather than complaining about this, rather than sitting there and pointing at the people who have taken the time or used the resources to get the information and figure out how to use this to their advantage, instead what we should be telling people is you can do this too. You can use these exact same rules and you can use the tax code in order to benefit from it. There's no difference between Jeff Bezos buying stock and holding it as it goes up and not paying tax on that wealth creation than you doing the same thing. You can go to SoFi.com/pomp. You can buy a stock, and if it goes up 500%, you won't pay taxes either until it is sold. That's the tax code. So it's not the wealthy people are doing something nefarious or malicious. It's just that we have a financial education gap in this country. They are educated on this stuff and everyone else isn't. And so rather than trying to take from the people who figured it out, the entire point of this show is that we should go and we should ask every single person who figured it out, how'd you do it? Hey guys, bang bang. Thanks so much for watching the Best Business Show today. And don't forget to check out our partner, SoFi. They make all this possible. They're a super app that lets you save, spend, borrow, earn, and invest all from one single platform. And if you go there today and you sign up for a SoFi Invest account, you can get between $5 and $1,000 for free from SoFi. Not everyone's obviously going to get $1,000, but everyone gets something. Don't say that I never did anything for you. Go check them out at SoFi.com/pomp. Download the app and go ahead and open an account. SoFi.com/pomp. And make sure you come back and watch more of the Best Business Show. We're going to build the biggest business show in the world, and we need your help.